By topping high, Facebook is setting itself up for even higher expectations down the road. What will it have to do to meet those expectations, and can it do those things? Market Watch's Mark Hulbert, he doesn't think so, and he joins us today to talk about it. Mark, how are you?
Okay, how are you?
I'm pretty good. So you've kind of been a Facebook doubter. Stock's done well, companies beat expectations, but why don't you think that can last? But why don't you think that can last?
Yeah, I should start out by saying and taking a big mea culpa at this end. I've been bearish on Facebook for some time, and of course, I've been very wrong. So I need to start out by saying that, and somebody can be excused for saying they shouldn't pay any attention to me whatsoever. But I do think that Facebook, by beating expectations, has created these higher hurdles over which it must jump. And one way of looking at it is simply to focus on the price-to-sales ratio. The company, when it came to market, 25, which is huge. The S&P, for example, is in the low single digits. So if you look out 5 years, what will its price-to-sales ratio will be? And one way I talk about this in the column is to look at what the average internet company's sales ratio is 5 years after its IPO, and that average is 5. So if indeed Facebook is able to hold up just merely the average internet IPOs, its sales are going to have to quintuple over that 5-year period as its price-to-sales ratio contracts by 80% in order simply to stay even. And I think if investors do the math, they'll realize that even when it's doing well, and I'll be the first to say that Facebook's revenues are growing at a faster pace than many had expected, it's going to have to grow at an even faster pace if you project that in 5 years' time, it's not going to be at a lower price.
Well, and that's one of the things you hit on is the projection for sales in the first 5 years of publicly traded companies. And I think we had just pulled that chart up. We'll pull it up again. Facebook looks like they're kind of in line with other companies. That's not really a good thing, though, is it?
Well, that's right. I quote some research that looked at all IPOs between, I think, 1995 and 2007, and looked at their average revenue growth rate over the first 5 years of their lives. Believe it or not, Facebook is almost exactly online over its first 2 years as a publicly traded company, which is good, by the way, but nevertheless not good enough. If it simply matches the growth rate of the revenue growth rate of those IPOs between 1995 and 2007, then it's facing a much lower price on its 5th anniversary as a publicly traded company. The only way to avoid that, if its revenue grows at that average pace, is for it to be trading at a much higher price-to-sales ratio. One thing to remember is, let's say it's another Google, which of course is the analogy everyone draws. Well, on its 5th birthday as a publicly traded company, Google's price-to-sales ratio, I think, was 6.4 to 1, still higher than the market. But even if